All right, we begin, of course, with oil prices, $64 per barrel for Brent crude. West Texas Intermediate about the $62 levels. We are seeing supply concerns in Iran, where they're set to reject a proposal from the United States with respect to the nuclear deal. Also, that brazen attack from Ukraine on Russia's fighter jets, that also raising worries or concerns about Russia's ability to put up oil. Of course, Russia under sanctions. And then Canada, the wildfires impacting oil facilities in Alberta that have been shut down. Whole lot going on in the oil and gas space. Let's head to London, where we're joined by Dr. Chinnan Dikwal, who is the Vice Chair of the African Energy Council. Doctor, good morning to you. Always great to have you on the show. Been a while. I should be saying Happy New Year to you, possibly. What do you make of the movement in oil prices over the last 24 hours?
Yeah, Ross, thanks for having me. So honestly, it's been quite a dynamic 24 hours, but even more dynamic if you stretch it back 2-3 days. And if I start from there 2-3 days, so many of you would recognize on Saturday, we had a meeting of OPEC Plus. So OPEC Plus, Saudi, all the OPEC members, including Russia. So that was an interesting one because many analysts had looked at, the amount of cuts that they've been rolling back, and we thought we'd see higher numbers. The numbers came out, so in terms of the production, so many of you would recognize in 2022, about 2.2 million barrels was taken off the market, stabilized prices. OPEC is now rolling back those cuts right now. So the numbers for July, based on Saturday's meeting, is 411,000 barrels per day, which they will add onto the market in July. That, of course, as you can imagine, dampened expectations. The oil price took a bit of a hit. But in the last 24 hours, exactly what you described there, Rotis, in your introduction, we've seen some wildfires around Canada, around Alberta region. Approximately 350,000 barrels of tar sand, oil tar sands at risk there, so have been shut in. So that means demand, some sort of constraint around demand. But exactly to your point as well, the negotiations we're seeing with the US, Donald Trump talking to the Iranians trying to get a nuclear deal, it looks like that's not going too well. So potentially, again, if that doesn't go too well, then that means that Iranian oil will still be constrained from coming onto the market. Again, the supply constraint. So those two things together is what's making the price of crude at $64 per barrel today for Brent, which is where we've seen it.
Now, we have projections from, the IMF, Goldman Sachs, Morgan Stanley. They're pretty much seeing oil prices staying under $70 a barrel. In fact, Goldman, they're looking at, under 60 through to the end of 2026. But the IMF is looking at under $70 through 2025 and 2026. Where are you in line with those projections? What are you seeing in terms of the price trajectory to close out the rest of the second half of this year?
Great question. So, Reuters, honestly, at the African Energy Council, we look at these numbers as well, and we'll come up with our own forecasts. And our internal numbers, which I'll be very clear, is honestly for the year 2026, I'll say the next few quarters coming in, we do not see the price of crude oil above $68 per barrel. In fact, at the close of the year, we think because of the production costs that are being unwound right now. So, just to be clear, in April of this year, OPEC put 137,000 barrels onto the market. In June and now July is going to be about 417 each of these years. By the time we hit July, would have been 1.37 million barrels that have been put onto the market. So supply is increasing astronomically. Demand is not catching up. To your point, some of the numbers coming out of IEA, the demand numbers for this year, demand growth for this year is around 750,000 barrels for the year. So supply is outstripping demand. Because of that, we see that the price honestly is going to be much, much lower. I know Goldman are saying $58 per barrel, which I think, if you ask me, I think very, very conservative. But the reality of it is the question remains, if you are a country like Nigeria, like many of the African countries, how do you hedge against these price risks? What's your budget based on? And I think these are the fundamental questions. Our fiscal break-even for our budget is $75 per barrel. I think that's where we should start to have a discussion. If oil is at 64 and we are $74 per barrel, our fiscal break-even for our budget, I think these are the discussions we should be having.
Exactly. So on that point, I mean, what does Nigeria do? I mean, it looks well, she's borrowing, so there's, a request to borrow more money. But then does she sell assets? Government-owned assets. What do you think with $75 benchmark and at 64? What should the country be doing?
Good question. So, Rogers, there's a huge deficit that we have to finance even now. So, if we look at the average of the year, way lower than our fiscal rate. In terms of asset sales, I'm a fan of it. And I know already the president has given the mandate to NNPC to look at all the books and, see what assets, we can put onto the market. I'm a fan of that, but I look at that with a lot of skepticism. I would rather take those assets, liquidate them and turn them into new assets that we can monetize as opposed to service our debt with it. I think what Nigeria should do, if you ask me, is this. Nigeria needs to look at where we stand today, very intelligently, and see ways in which we can raise debt in a very cheap way. Number two, we should see how we can hedge our price risk. The clear mandate that the president has given to the new board of NNPC, and Reuters, you've seen that, is that he's asked them to see how we can increase production in the short term. And we have increased production over 30% since 2023. Production has gone up about 30%. So now we are putting additional barrels onto the market. Additional revenue is coming in. The big problem, of course, is a lot of that is already encumbered with forward crude sales from the past. But the real value today is seeing how we can increase production in the very short term. Now, Reuters, this will probably lead us into a discussion. What have we seen over the last 3-4 days? The president has just given an executive order around cost efficiency. And I think that's what becomes really exciting, because cost efficiency means you would attract more investment in the very short term, but not just that, you'd also increase revenue in the very short term, because all of a sudden you start to look very attractive to the marketplace. So if you ask me, what does Nigeria need to do? Oil is our mainstay. We should today start to see how we can increase production very, very rapidly and decrease wholesale contracts, which I think is one of the things that's holding us back in a big way.
All right. So you did mention that executive order that the president has signed in Nigeria. I want to quickly touch on Senegal. What do you make of this rift between Woodside Energy, the Australian company, and Senegal? This seems like they're filing a dispute over taxes or something. Well, what do you make of that development?
Well, Roses, this is a really sad one, if I'm honest. For me, personally, it's a very sad development. Sad for several reasons. One, Senegal, if you talk to all analysts, is looked at one of the most stable places in the world for investment, particularly for oil and gas investment. Okay. Unfortunately, this litigation now means that crown was taken away. Their risk premium goes up very significantly. But beyond that, I would say this actually, which would surprise a lot of people. This is, so just for context, this dispute is between Woodside Energy, which is an Australian company. They were exploring in Senegal for a long time. They found crude oil in what we call the Sangomar field. The Sangomar field is about 100 kilometers south of Dakar. Okay, so Woodside Energy found oil, and they are in joint venture, in a PSC contract with PetroSen, which is a local NOC company. Now, I'll say this. Unfortunately, the working interest for that field is 82% Woodside, 18% to PetroSen. So think about this for a split second. The landlord only has 18% of the field. An outsider has 82% of the field. Now, I'm not trying to whip up sentiments here, but I'm just making the point. Yes, there's a dispute here. The dispute is not around working interest. The dispute is around, taxation and taxable revenue and all of that stuff. But the reality is you cannot help but look at the skewing of the working interest. In fact, if I was to compare this with Ghana, when Ghana started the Jubilee field and the 10 fields, it was the first foray of Ghana into oil and gas, the very first field, like Senegal. So FYI, Sangomar is Senegal's very first field. It started producing end of last year. When Ghana was doing Jubilee field in 2012, its working interest in that field at the time was around 40%. Here we've got Senegal, 18%. So the point I'm trying to make is, there are cost pressures and revenue pressures that Senegal is trying very desperately to feel. And it is trying to feel that in retrospect, because it already made a bad deal at 18% of the value of that field. But without a doubt, this is a thing of taxable revenue, that they have. So some royalty, I think some discussions around that, but other discussions as well around, because Woodside Energy bought Clean Energy in 2020. So I think there's also capital gains discussion around that. But anyway, the baseline of it is this whole discussion is with the World Bank International Center for Settlement of Disputes. And with all due respect, by the time you get to that point, I honestly do not see how Senegal can win this argument. There are several downsides to a deal, which is really heartbreaking. It's their first foray into oil and gas. They have a small working interest. They do not have any say on the table because it's a PSC agreement, it's a production sharing contract, so you cannot influence it. Number two, even things like the value chain, you cannot dictate the value chain because you're a minority partner, you're a carry partner. The deal just does not work for them on any, by any stretch of imagination. And I'll be very surprised if they have any leverage at the international court.
Dr. Chinnan Dikwal, Vice Chair, African Energy Council, it's always a pleasure talking to you about oil and gas. We thank you so much for talking to us about global prices, Nigeria's pathway as far as executive orders to bring investment in, and also this dispute between Woodside Energy and the nation of Senegal. Thank you so much for your time. I hope to catch you again soon. Appreciate it.